back. Here is the last session of Chapter 2. We are going to talk about certain factors that are going to lead market to away from its efficiency. Now, what we mean here is actually the human factors. Now, the first premise under market efficiency is that we have active investors who make an unbiased, or let's say justified reaction or reflection of information they receive. And also, their investment decisions are independent of each other. But in a reality world, the investor may not make a fair judgment about the information. They might value some of them more and ignore some others. And also, sometimes there is, let's say, a somehow cohesive way between different investors, and they tend to move together, which is also against the premise under market efficiency. Now, the factors that lead the, let's say, investor to make an unfair judgment about the information is normally related to psychological factors or even, let's say, cultural or, let's say, social factors. So in finance, we actually develop a discipline of study that focusing on people's bias when making investment decisions that are likely to be, let's say, social or psychological based. And it is referred as behavioral finance. So this is one explanation over many market anomalies or when the market moving away from its efficiency. Now, let's look at some of these psychological traits. Now remember, we are all people. We have flaws. This psychological bias can happen to everyone. Even you are a professional, it might still for you to have this biased judgment. Sometimes it is not even aware by ourselves. Let's say we mainly talk about these 4 types of bias here, but the actual bias in real life is much more than that. The first one is the prospect theory. The prospect theory is actually very interesting. So it refers to that people focusing on the changing trend of a certain security, its price, rather than, let's say, the absolute value of this security. And it also indicates that people are more sensitive to loss rather than gain. For example, if we have the same amount of loss and gain, the loss gonna give us more regret than the joy we have the exactly same amount of gain. So, if we are totally rational, then the regret and joy should equal to each other. But we tend to be more sensitive or have a larger magnitude in emotions when we have loss. Now let me give you an example. So I have here 2 portfolio managers. They are both telling the truth, and they are describing the exactly same investment fund. Now, the first portfolio manager told you that this portfolio, this investment fund, has been performing very well for the past 3 years. It has an average, pay attention to the word, average, 10% rate of return, which is higher than the concurrent market return. So, sounds very inviting, right? Now comes to the second portfolio manager. I told you that this investment fund is performing really well for the past 5 years. However, for the past 2 years, it has shrinking its winning trend. Now, that indeed raises alarm. Now, if they are both telling the truth and they are telling you the exactly same investment fund, which one would give you a higher chance of investments? to allow you to invest, to invite you to invest? I think it's the first one, because it tells you that it has a 10% rate of return. However, for the second one, it tells you that for the past 2 years, it has shrinking its winning trend. That doesn't sound too promising. So, for the exactly same fund, two statements lead to two different investments. Now, if we have only been given the statement from the second portfolio manager, we might miss out. Because even though this investment has smaller winning trend during the past 2 years, it is still a very promising investment given its historical return of 10% in average. So, if we follow the suggestion only from the second portfolio manager, we might miss out. And that is not what we want in finance market. So, why do we miss out? Because we have this constant fear towards loss that might keep us away from the true promising investment. So, that's the theory, which is also referred as loss aversion. Now, the second type of bias is really common, even not just around investors, but even some top managers who runs the firm. It's overconfidence bias. It indicates that people always assume they are making the best judgment about a certain security. And if there is a gain, it is because of their superior analysis skill. If it leads to a negative return, then it would blame all the bad returns to bad luck. So they always assume that they have the full judgment about everything, and that leads them to only focusing on information that are in support of their decisions, and they're going to ignore the information that raise the alarm. Now, if we are a rational investor, what we should do is we would value this information equally. If we don't, then it breaks the premise of a full, true, and justified reflection of information. Overconfidence, always pay attention to that. Don't assume you know everything. Always open up to all the information you can get and make an informed decision. Now, the third type of bias is referred as noise trader. Now, we assume we'll talk about the market efficiency. We assume that the investors are independent of each other. But noise traders, they tend to move together, and they would always tend to follow the information source that have less credentials, that are less likely to give you the true information. So for most of the time, the noise traders and their information source are always wrong. Now, that's quite dangerous because the presence of noise traders and their investment behaviors can lead to unnecessary price turbulence or unnecessary stock movements. And that's dangerous because it might lead the stock price to be away from its true equilibrium. It might also take longer for a stock restock or revert to its mean. And if that lasts for a really long time, it might lead to market inefficiency, market misfunction. Now, the last one is escalation and bias. This refers to that people throw good money into bad investment rather than good investment. Now, that sounds quite silly, but we all might come across that. So it refers to an investor buys a stock and there is a drop in stock price. And instead of dropping the investment, the investor secretly hoping that the price of the stock can raise back to its previous level so they can have a recovery from the loss. Now, this is bias because we never know whether it's going to reach back to its previous level, and also we will never know where is the true bottom of this stock price change. So what's rational for you to do is drop the investment and find other investment that are more likely to give you a positive return. Only in that way you have a larger chance and also a quicker manner to get your money back. Now, we might all find ourselves in real life to be set in a very undesirable situation. So you need to find the courage to say goodbye, and tomorrow it will all be better. So all these forms of behavioral bias are actually set inside our mind. It's more like a gut feel. It's not what your brain is thinking. And these investment decisions are normally backed up by sentiment. That's your emotions. And we should never make investment based on emotions. We need to make an informed and educated decision over our investments. So what can help regarding this bias is that just listen to this class. You will find yourself in a much better place. And also, when this bias occurs, it are reflected in share price because share price are affected by the traits of people. When we make a judgment that is biased, that lead to biased investment behavior and lead to a biased stock price. So these are referred as investor sentiment. So it is the end result resulted by behavioral bias. Now let me introduce a concept of fusion investment. So fusion investment refers to a, let's say, mixture or coexistence of fundamental analysis and investor sentiment. So fundamental analysis refers to textbook evaluation method, such as dividend growth model, the CAP model, that's capital asset pricing model, and also the DCF model, that's discounted cash flow model. So these are the strict way, that's the rational way when we do a valuation. So these are the fundamental analysis. They believe that there is an intrinsic value for all these securities out there. So fundamental analysis, what they do is they find this intrinsic true value of the security and they compare the current price with this theoretical, let's say, intrinsic value. If the current price is higher than the intrinsic price, they will not buy or short sell this security. If the current price is lower than the theoretically right intrinsic value, then they will buy this stock and wait for the increase in stock price and harvest their gain. Now, let me refresh your memory. Remember the technical analysis which we talked about in session 2. Now, the technical analysis and fundamental analysis, they are two distinctive investment strategy. Now, technical analysis believes that there's no use in detecting the intrinsic value of a firm or of a security because the current price is a reflection of past market movements. There is no point of identifying that because you just need to follow this previous history. That's it. So these two lead to very different investment result or investment behaviors because they based on different information. Now, which one is, let's say, superior? We will never know. The best way is you use both and to find out which one turns out to be a more profitable one. Now, here are the investment analysis of this chapter. Now, let's make a quick summary of this chapter. The first one is the concept of efficient market. Always remember, when we talk about an efficient market, we mean information efficient rather than price efficient. And also, the market efficiency have multiple forms that can be semi-strong, weak, and strong. The aim behind that is you identify yourself in the status of market efficiency, and then you know what type of information you can use to harvest gain, or you know what kind of strategy you should follow. Now, we also come across the testing method to let us know whether the market is in certain form of efficiency. They include timeline and cross-sectional analysis. Timeline analysis include the earnings report and also some calendar effect. And the cross-sectional analysis include testing on firm characteristics such as the size effect. And lastly, we have the event study that testing out market event and firm events such as IPO, stock split, and also worldwide economic events. And also, lastly, we have go over some of the behavioral bias that can explain many market anomalies, or let's say, when the market becomes inefficient. All right, that's it for the chapter 2. Now, this chapter is really hard because it's all pure theory. You have done a really good job following me through to the end of this chapter. All right, thank you. I will see you next time. Bye-bye.